Hi, it's Ollie from Get Geek Finance and welcome back to my channel. Have you ever wondered what is the best months of the year to buy stocks? Or perhaps have you ever wondered what is the worst months to buy stocks? Or have you ever wondered what is the best day of the week to buy stocks? Or is it better to invest a lump sum in the market all at once, or to dollar cost average, which means spreading it out over time? Well, in this video, I will be answering all of these questions. If you get any value from this video, then I'd really appreciate an early thumbs up, as it massively helps support the channel. Now, before we get stuck in, I must be clear, I am not a financial advisor, and nothing in this video is intended to be financial advice. And if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so you should always do your own research, because this video is just for entertainment purposes only, and past performance is not indicative of any future results. And this includes the best days, hours, or months. You should also take all this information with a pinch of salt, because the thing with investing is that everyone's trying to get ahead of the curve. So if everyone knows a particular day of the week or month performs better than another, then most people would go one step ahead of this to get ahead of the curve and buy in the day, week, or month before. But putting this aside, there are a few events in the year that investors generally look out for. So first up, we have the January effect. Now, this is where at the beginning of the year, the stock market tends to go up. And this is because of something in America called tax loss harvesting. And this is something that people do to reduce their taxable income or pay less tax. And the way people do this is by selling some of their losing stocks towards the end of the previous year and then buy back into the markets sometime in January. So this often pushes the market up. Another theory for the January effect is that people make a New Year's resolution to start investing in the market, which may also give it a little rise. The stocks that typically get affected by this are small cap and value stocks. So between 1928 and 2018, the January effect has occurred 56 out of 91 times, so roughly 62%. The end of December is also known to be a good time to buy stocks, because at the end of December, we often get something called a Santa Claus rally. So a Santa Claus rally occurs in the last 5 days in December and the first 2 days of January. And typically the stock market goes up. There are lots of possible explanations for the causes of a Santa Claus rally. One is that it's a result of people buying stocks in anticipation of the January effect. Another possible reason is that there's a general feeling of optimism and happiness on Wall Street, and people are investing their Christmas bonuses. Alternatively, another theory is that some very large institutional investors who are often more pessimistic tend to go on holiday at this time, leaving the market to retail investors who tend to be more bullish. Also, institutional investors close their books and will de-risk before their break, which means basically closing any shorts, which in turn creates a lift in stocks. Or another possibility is that the final week of the year typically trades on the lowest volume of any days through the year. Because of the lighter volume due to people being on a holiday, it makes it easier to move the market higher. Or even another possible explanation is there is a slowdown in tax loss harvesting that depresses prices at the beginning of December. But in reality, it could even be an amalgamation of all of these. And over the past 92 years, a study done by Sundial Capital Research stated that the S&P 500 gained 77% of the time during the Santa Claus rally. And the average gain in this 7-day trading period tallied 2.66%, which is far more than the average performance over a normal 7-day period. But what's interesting is that if the Santa Claus rally doesn't happen, then the January following is usually going to perform negatively. So the next calendar event you need to know about is in May. And there's an old saying in the stock market, sell in May and go away. Or the old saying,
sell in May and come back on St. Leger's Day,
where St. Leger's Day is in September. And this old expression is thought to come from 17th and 18th century Britain. Please ignore my terrible impressions. The thinking behind it was that wealthy investors and traders would quit London in May to spend their summer months abroad, where they wouldn't be able to monitor their stocks or positions. So many would sell their stocks and use the money to go on holiday and then come back on St. Leger's Day, which was traditionally in mid-September. And when people sell stocks, it causes the stock market to drop. According to an article in Forbes, between 1950 to 2013, the Dow Jones Industrial Average had an average return of only 0.3% between May and October, compared with an average gain of 7.5% during November to April. So sell in May and go away generally targets market activity between May the 1st and Halloween. October has a bit of a stigma against it, and this is called the October effect. And this is the perception that share prices tend to drop during this month. Some of the worst market crashes in history have happened in October. Despite the crashes, it's actually been really good for investors. And interestingly, it's also the month that ended the most bear markets out of all the months. So between 1950 and 2020, the best months historically in the S&P have been April, followed by November, then December, then surprisingly July actually, then January. November through January is generally a strong stretch, but September always seems to come out the worst. And even between 1950 to 2020, the worst month was September being down on average 0.62%, followed next by August being down 0.16%. Now further to this, there are some people who believe that certain days offer systematically better returns than others. Some people believe that the best day to invest is on a Monday, as the stock market has had a tendency to drop on Mondays. And this is called the Monday effect or the weekend effect. Seems that everything's called the effect. The reason for this is that companies tend to release all their bad news late on a Friday evening or over the weekend. And the reason they do this is that people are generally busy over the weekend and less likely to notice. Or come Monday, people are back to work and companies hope the bad news has subsided or been forgotten or something worse has taken the limelight. So this is why Mondays often open in the red. Some people also attribute Monday stock price drops due to workers' dissatisfaction of going back to work, leading to pessimism in the market. But because of this, it makes it one of the best days to buy stocks. In contrast to this, Monday is also considered to be the worst day of the week to sell stocks. Now, there is a lot of inconclusive evidence as to which day is the best to sell stocks. In reality, you should sell a stock when the stock has reached the point that you considered a good exit. Some sites suggest that if you're trading, then Friday may be the best day to sell stocks before prices dip on Monday. Prices tend to rally on Friday afternoons, and even more so on the Friday eve of a 3-day weekend in the US, possibly due to positive feelings heading into the long holiday weekend. But you should remember, each week should be judged for its benefits or potential pitfalls, regardless of whether it's a Friday or not, as often there are factors that could affect the market. For example, upcoming earnings or CPI data or a Fed meeting. So then this leads to the question of why wouldn't you just sit out the bad months in the stock market and then invest in the good ones? Well, to understand this, we need to answer the question, is it better to dollar cost average into the market, aka spreading out your investment evenly over the course of a year, or to lump sum invest? And surprisingly, I'm going to say something which you're not suspecting. According to this CNBC article from last year, new research looked at 10-year returns on $1 million starting in 1950 and compared results between an immediate lump sum investment and dollar cost averaging. And assuming a 100% stock portfolio, the return on lump sum investing outperformed 75% of the time. But this goes against the general consensus of what most investors should do, and that is dollar cost averaging. And the real reason people pick dollar cost averaging is to avoid the risk of falling in the 25% where you time the market badly. This is why people will choose to make less money if it means risking less as well. People who lump sum are generally those better off than the majority of us retail investors, and they are those who have millions to put in the market. And I don't know about you, but I definitely don't fall into this category. So for the majority of us, it's safer for us to invest over a period of our lives, like when we get paid our salary each month. Many professionals advise that it's best to stay invested because research shows that big market drops tend to precede large gains. And if you close out, then you could miss the potential upside. What's crazy is if we look at this CNBC article here, if you miss the 10 best days every decade since 1930, your return from the S&P 500 would be only 28%. That's 28% over 91 or 92 years, which is just mind blowing. But if you had stayed invested, then your returns would be 17,715%. Even in 2020 alone, you would have made 18%, bearing in mind this article was made in 2021. compared to minus 33% if you missed the best 10 days. If you went back to 2010, then for that decade, your returns would be 190%. And if you missed the 10 best days, your returns would be halved to 95%. So if you try to time the market, you're likely to do very badly. So in conclusion, it's important to remember that when considering the best time to trade, that past performance is never an indicator of future results. And each day, week, month, and hour should be analyzed in its own right by you as an investor to determine what's best for you. And according to historic data, then technically April should be the best month, but currently this April, the S&P 500 is down over 7% at the time of this recording. Plus, it's worth remembering that anytime patterns are identified, then traders or investors often try to get one step ahead, and so over time, these results dissipate. So anyway, that's it for this video. If you enjoyed this video or got any value from it, then please smash the like button. If you've got any questions on this video, then please let us know in the comments below. Let us know if you lump sum invest or dollar cost average. And if you have lump sum invested, do you ever try to time the market and has it paid off? Let us know below. I'd love to know, and I read all your comments. Also, if you want to learn more about personal finance or investing, I have loads of videos on my channel, so I recommend you subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.